Welcome to Trends with Benefits, an award-winning podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I am your host, Ed Lopez, and today my guest is Eric Fine. He is portfolio manager for VanEck's active emerging markets fixed income strategies. And guess what? We'll be talking about emerging markets and emerging markets fixed income. Hey, Eric, thanks for joining.
Hey, Ed, good to see you.
Where do we start with this? I feel like we've been doing a little bit more on emerging markets together. We just recently did a webinar with Jan VanEck as well. It almost seems like the tide is turning in emerging markets as a potential investment destination. I don't know. What's your take? Are things changing? Have they changed? This is probably kind of just a tee-up question, but is the time now for emerging market bonds?
Yeah, I think a lot of the recent themes. What's one of the most recent themes? High inflation, right? What's the inflation generated by? Food and energy. Who exports food and energy? A lot of emerging market countries, and in the bond world, my world, it's a much bigger part of the countries that issue bonds. So there's improved fundamentals that are being noticed as a result of that, but I think the big difference is that EM bond yields are much higher, and carry is a huge component and one of the best or least bad predictors of future returns. So all bonds are getting more attention, especially front end of U.S. And as that discussion begins. When investors begin to look at what should I invest in inside the bond universe, EM is going to be, I think, an inevitable answer. We can talk about why I think that, but and a broader thing is EM's had a bad 10 years, but it's had a really good 20 years or longer. There's a really good setup now for EM because it's paying high carry and it's benefiting from a lot of global tailwinds like higher commodity prices that are headwinds for the other types of investments that investors have in the bond world.
Yeah, no, absolutely. We've been talking as a shop about fixed income and the potential for bonds. Is it fair to say bonds are back?
I think it's fair to say you're going to get the revenge of the 60-40 model. We ran an efficient frontier just for the last 10 years, and the model says 60-40. That's kind of interesting. Now, it was an unbounded model. We're not allocators. But yeah, no, I think you're going to get the revenge of 60-40. There's been a huge de-risking from bonds. And the yields are higher. And it could be a sideways bumpy world. Yields may be low and risk-free yields may be low because risks are high. And that's not, that's a world where equities are not an obvious choice, where sideways and bumpiness may be a reasonable base case, in which case you're going to want carry, curated carry. But you're going to want carry. And luckily in EM, you have a lot of things that are benefiting from the thing that's challenging the world, right? So you have oil exporters, you have fertilizer exporters, you have tourism exporters. Anyway, you get the picture.
From a U.S. investor standpoint, how much does U.S. policy, monetary policy, play into the rest of the world, play into emerging markets, or influence the potential that you're seeing these days?
Yeah. So first, U.S. policy. Let's break it down into two pieces. One is, are we growing or not? So that's kind of a function of policy, but it's something of an input in the system. The other is, what's the Fed doing? What are U.S. interest rates doing? So that's, I guess, maybe let's focus. Let's just put aside the other one. U.S. is probably facing a recession. So it's not going to be a good part of the story. And countries that are linked to the U.S. are not obviously good candidates. So we have very little Mexican peso exposure, for example, because U.S. rates may be low because of weaker growth. It's not an overall good story. What's the big unpriced risk in the world right now? The new thing that no one's positioned for? China reopening. So Thailand, Indonesia, Malaysia, those sorts of markets look much more interesting because they got a positive growth story. And they're generally maintaining good policy and paying us, plenty for their risks. So that's on local markets, right? Because the demand story in the U.S. is not looking awesome, whereas China's this big new thing, right? They're reopening, right? Eliminating COVID restrictions. It looks like, right? Now that's exaggerating, right? And it's hard to interpret the tea leaves. So that's one angle of the answer. The other angle of the answer is the Fed determines the US dollar interest rate, and a big chunk of the bonds we invest in are going to go up or down based on what the US rate does. And there, we're very constructive on duration for the time being. And the market is not really treating it as negative for now. In other words, duration, we like long dated bonds. And we think that when the risk-free yield, when US bonds continue to rally, they'll rally along with them. Because first, they're supported by things like oil, et cetera, right? We're curating, we're picking things whose spreads aren't going to widen while the rally happens. But also the market's kind of treating it that way. Fine, the last 2 days, the market's kind of figuring out that the Fed is going to punch it in the nose at some point. But I think positioning is still kind of weak. I think we still have more to go on that. And that's maybe a moment, to worry about, but we don't worry about it. It's kind of a really, really good setup for EM. We can talk about more broadly why, but yeah, no, I think U.S. policy can have an impact, but there are great ways in the EM to adjust to the bad news in the U.S., to the good news in Asia, and to the nuances of, well, rates, could continue to go down, but that can be a good thing, right? I can get the good stuff with it. I get the growth with it by being in Asia and not deal with the negative aspects of it in places that aren't growing.
Let me just break apart one of your last comments about duration, that you like duration. I'm assuming you like duration in emerging market bonds because that's what we're talking about. And why is that? When the U.S. is still raising interest rates, is it because emerging markets generally, their central banks have generally stopped raising rates?
Well, so duration, the way I was just talking about it, duration is easier to talk about in dollar bonds. So let's just talk about it in dollar bonds. There are two components. There's the risk-free component, which is if U.S. interest rates go up by 5 basis points, all bonds denominated in dollars, all things equal, should also go up by 5 basis points. And vice versa. If they go down, the opposite should happen. And of course, the interest rate goes down. That's good, right? The price goes up. Then there's the spread component with risky bonds, and the riskier they are, the bigger the spread. And with riskier bonds, you have an additional duration component or spread. You have an additional risk component, which is the spread, and it's a risky yield, and that can go up or down as well. And so there's spread duration and risk-free duration. Those are the two basic components of when you have an exposure. Now, if I own an investment-grade bond that's has very low volatility, low beta, there's going to be a big component of the risk-free yield in it. And if I own a high-yield bond, there's going to be a lower component of the risk-free yield and a bigger component of the spread yield. Why do we like duration? Well, breaking it down, because we can find a lot of bonds with spread duration where we think the risk is improving or good, right? And like I mentioned, a lot of commodity exporters, it's very diversified. In dollars, we have a lot of small slices and really good, interesting, improving stories. Exporters generally around the world, ranging from high-rated Saudi Arabia and Qatar to lower-rated Argentina, where the dollar-denominated bonds are very unlikely to default in the near term, and they've got a lot of debt, but it's to the IMF and it's rolling. In other words, they're rolling that debt. In other words, when you get into details, you can come up with a very good diversified portfolio of dollar bonds where the spread component is safe or even has tightening risk. And why do we think the risk-free component is declining? Because the Fed is super hawkish. And we think it's going to continue to be, and that's what the market is saying. So the curve can continue to invert. Now, there's going to be an end to that. But for now, that's the dynamic. Not the last 2 days, but that's the dynamic. And so if that's happening, that's Goldilocks. That means no headwinds from yield, and we can find plenty of things that are going to, we're not doing it for that reason. We don't invest in those because we have an opinion on the risk-free yield, but we're not worried about the risk-free yield. We're not saying, well, we have to really reduce duration because the Fed is getting ahead, behind the curve on inflation. They're getting ahead. The risk is they're going to send the U.S. into a much bigger and deeper recession than people realize. So it's kind of a Goldilocks setup. I hope that was clear.
Yeah, and how does the U.S. dollar play into your analysis? In FX rates, in terms of the opportunity or the environment in which is best for emerging market bonds or emerging market assets.
We're a blend fund, so we invest in local and hard, and in sovereign and corporate for all emerging markets. And our benchmark is 50% local currency, but we're rarely there, right? We're rarely there because it is a much riskier sector. Right now, we have about 50% of the fund in local currency. So people top down, you would say, oh, you think the dollar is going down. Now, we don't look at the world that way. When we have discussions on dollar, most people have a general sense of the dollar, and what they have in the back of their mind or the front of their mind is Dixie, dollar euro or dollar yen. Relative interest rates and relative growth rates could favor the dollar against those. We look at the dollar country by country, and we look at their bonds, right? So their currency may not be super attractive, but if their bonds are extremely high yielding, then the yield will reflect the value instead of the currency, right? They're the same thing because you're paid that yield in that currency. So it shouldn't differentiate too much between the two. But when you look at the details, it's very curated. Malaysia, Indonesia, Thailand, very exposed to China reopening, very under-owned. The technical's fantastic there. The big outflow from EM bonds this year was from Asia-dedicated and Asia-related EM bond funds. So the technical's really good. And you have this, surprise, I think, still unpriced China reopening. So you can have that risk without getting into a lot of beta, essentially. So I think you can get pretty good alpha. I think the alpha to beta ratio is pretty good in those, and you can get duration there safely. Those are pretty safe defensive names. And so if the inversion of the U.S. yield curve continues, that's going to be very supportive of duration there. Whereas in other places, like a riskier, higher beta place, their local yield curve may sell off because the low yields in the US reflect bad conditions for their particular country. But in this case, the low yield curve in the US is just there, and they have good conditions in their country, right? Inflows. That's a big way we're expressing it. We don't have South Africa, for example, because it might benefit, but there's a lot of political risk there. We've only recently gotten into Brazil because it wasn't showing up as cheap, and there was a lot of political risk. It got priced. Now it's cheap in our process, and so we're neutral on it. But it's very important to curate these things, and it's very important it's okay to notice global events, but what you do about them is, I think is important. The details really matter.
Yeah, I thought it was just important to highlight that you got to look at it in a nuanced way. That as you mentioned, the Dixie or the DXY, the dollar index, is not necessarily to other emerging market countries. So maybe there are other factors to consider there as well. So in some sense, can you see an environment where even if the dollar is strengthening, emerging market assets could do well?
Yeah. No, I think I could easily see that, and I think it would be fine. It would not be an unusual. It would be an environment arguably bad for stocks. Now that I'm thinking about it, I hadn't thought about that. Because you could argue, or a lot of people think that there's a relationship between the dollar and stocks. So it's probably adverse for the stock market, which is consistent with kind of Jan VanEck's view that we're going to have a bumpy sideways world. But he also likes non-dollar. He also thinks the dollar could be turning down, and so that could be right if expressed in a curated way, right? And we are kind of in this new world where the three main currencies, dollar, euro, and yen, are competitions for the least dirty shirt. So, right, they're all doing money experiments. They all face, real structural challenges. So, I think that could be a good world. That maybe that's going to be Jan and I's next. I'll mention that to Jan. It's an interesting. Yeah, it's something we have talked about, but not that specifically.
And as I think about emerging market bonds, I do invest in fixed income myself, and looking for those different opportunities. But I
invest in our fund.
I also like to kind of think of it from maybe a financial advisor standpoint or another investor standpoint that is looking for income and perhaps have shied away from emerging markets. And sometimes you see articles, like there was one in Bloomberg, I believe, today, talking about emerging market countries feeling the sting of local debt. And of course, they're highlighting Sri Lanka, Ghana, Zambia. And I wonder if you have a take on the way the media covers emerging markets, and if there's something that regular investors should consider. We talk about fundamentals in the emerging market landscape. A lot of times what the media covers seems to be the smallest countries out there.
Yeah, the media, I think it's appropriate for your audience, but there used to be a meme in newspaper rooms of if it bleeds, it leads, right? Nobody wants to hear about good news and good stories. Nobody wants to hear that Korea went from poor to rich before our eyes, that Poland went from, defaulted to and below investment grade to, I couldn't even tell you its rating now, but it's firmly investment grade. I love it because it makes this stuff cheap. Number one, this is the reason you have an opportunity. Now you got to curate, but this is number one. That's why there's the opportunity. Number two, Europeans and Asians have a very different attitude than the U.S. They have much bigger permanent allocations to EM and a much greater comfort level. Number three, if you look at a long-term, backward-looking optimizer, EM debt is, especially the higher yielding dollar bonds, is the best performing category of bonds, right? So you're supposed to, let's say for a portfolio volatility level of 6, you're supposed to have almost half of your fixed income allocation to EM high yielding dollar bonds. One of the reasons why EM has done so well is that the local currencies have done so poorly. And so that is why, on a long-term basis, 50% is not an optimal level for local currency. It's too volatile. And it can lose dramatic amounts, but it's absorbing and preventing crises. So that's another reason to be selective, but not hate it. It's fairly rare for us to have this much. We're just it's the result of a bottom-up process. But yes, you could add it up and say, I'm sure Jan is adding it up and saying, yeah, they don't like the dollar. We just we don't describe it that way.
What about this idea that it seems like over the last decade or so, many emerging market countries have warmed up to the idea of issuing in local currencies with the idea that it would be better for them. But now as interest rates kind of rise and some countries are dealing with inflation and rising food prices, that they could feel a pinch because of that and having to repay that at these higher rates.
I think it's the opposite of how you described. I can see how it could appear that way, but having a healthy local currency market makes you more independent of global trends. But these countries did feel the pinch of inflation. It's just that their reaction to inflation is very different than our country's reaction to inflation. They're much more sensitive to it. So the first hint of it, they start hiking rates. And if it continues, they overdo it, because they know that inflation kills the poor, kills the lower and middle classes, and because it destroys financial systems. And so they've hiked way earlier and way larger than the developed markets. And that has, yes, you could say, oh, it's punishing their ability to borrow domestically. But first, that's the entire point. And second, most of these countries do not have a lot of leverage. They're not the UK. That's going to be then a big lesson for developed market people, is that there are a lot of UKs out there. In other words, if the central bank can't hike rates to stop inflation because they're going to bankrupt the government, that's the first step towards what's called fiscal dominance. It's taught in economics, but almost no developed market economists study this or maybe even remember it from school. But it means that the monetary authority loses traction, right? It's a fiscally dominant situation, right? So the monetary policy loses its effectiveness. And the DMs have that, and that means that money tends to go away from places like that, and it goes to places like the EMs that can comfortably incredibly hike interest rates. So the presence of these local currency markets, yes, it can be a problem, but it's a problem if you have too much debt, and if you don't hike rates, and if you don't manage inflation on focus. And there are totally situations like that, but we avoid them. But most of the EMs, generally speaking, even Brazil, which which we got into after it sold off, they maintained incredibly high real interest, just not high enough for our investment process. But initially, but they maintain incredibly high real interest rates. I'm not, the inflation dynamic isn't, I worry about other things there than that.
Do you think developed markets are riskier in some sense than emerging markets?
They sure as heck don't pay you enough. So it's not so much central case that, there are these problems and declinism, although I think it's kind of just observationally, it looks that way. You're just not getting paid for these risks. So we have an investment process where we look at fundamentals and imagine them on an x-axis, so good ones and bad ones, and we compare it to how much the bonds of those countries pay. And in the bottom right corner, right, where the fundamentals are bad and they're not paying you anything, you know who's there? Greece, Ireland, right? All country, and then they blew up. Japan for a long time, right? A lot of the developed market countries are there because they have incredible. Now, my main point isn't so much, I'm totally sure that these things are going to manifest. Main point is you're not getting paid for those risks. That's the main point.
From a U.S. investor standpoint, looking at the potential for EM bonds in their portfolio, I'm just going to acknowledge that some people are going to avoid it. They just can't get over the hump and get comfortable with it. But what's one reason they need to pay attention to what's happening in emerging markets?
The reason I think it should be in portfolios is that EM has an answer to the three basic questions that have dominated headlines for decades now. And EM's done well in those periods, the last couple decades. How much debt can companies and countries sustain? Right? At least once a year, that's part of every outlook, right? That gets referenced. And we just talked about a specific dynamic. When debt is too high, central banks become less able to hike rates because they bankrupt the government. But what's a sustainable level of debt? Well, EM has very low debt. And that's a very practical consideration, not just because of the fiscal dominance that I mentioned, but because, for example, EM government bonds in dollars right now are paying in principal and interest about the same that they're borrowing. That's a really practical thing, right? So funds that own these things, they're getting more money, almost the same amount of money that the countries are issuing. That's an incredible technical. So number one, low debt is thematic, but it's practical. Second one is independent central banks. This is an inflationary era. You need central banks to deal with inflation, period. That's also not just a theoretical point. It means, number one, you're getting paid more while you're wading through this bumpiness. And second, if they do a good job, and since they're already later in their hiking cycles, maybe ending their hiking cycles, you can make money if they cut rates. And the last one is EM's benefit from the latest hit to markets, namely in food and energy price inflation. That puts them in a very different situation. It means they can grow. It means that they have more dollars going in than not, right? Their currencies tend to be bid. And it's a very, very supportive context, especially if they've already hiked rates. It's the only potential cost, and they've already adjusted for it. So now it's more the good part, right? They've taken the hard medicine. We're still taking the medicine. There are a lot of very important developments in EM, including the creation of new currencies and new currency blocks that are very credible. And so a lot of bad money, like the yen, euro, maybe dollars, will be seeking that. And to not be aware of it and be able to participate in it at some point, I think would be a big, big miss. So if you're not in EM, you should be aware of it because it's really important. It's going to be a decade plus phenomenon. Yeah.
So do you think things are different for the next decade than they have been this prior decade?
Yeah, yields are higher, so that's a good thing. That's a good setup. But yeah, the next decade, I think, is Eurasia's got to be. I'll just get into it. Yeah, so Eurasia, I think, is one of the biggest unpriced facts in markets, and it's the biggest example of why folks should be aware of what's going on in EM. The way to look at it, the characteristics or the elements of it are: Russia is redirecting all of its pipelines, gas and oil, towards Asia. They should all be done by 2025. So energy for an entire region, right? That obviously powers growth. So it makes China a little different. It's not as easy to say China's facing Japan disease, right? Middle income disease. It means financial infrastructure. And when you create something like that, good money seeks it out. And I think the bottom lines of that are risks to supply, right? And Saudi and Russia are cooperating. That's revolutionary for energy supply. And should be getting much more market attention. So a lot of supply risks, and it's positive for EMFX. And that's, I think, the biggest thing. That's probably, if I had to pick the biggest thing over the next 10 years, that's it.
You mentioned Russia, and I want to highlight the fact that in your own strategy that you actually had gotten out of Russia before the war. what kind of tipped you off on that, or what? I know you used to be a Russia analyst. I mean, I'd love to talk a little bit about your background as well, but just generally that call in your strategy of avoiding Russia.
Yeah, sure. Well, first, just for context, I've been doing EM for over 30 years, and I've, I guess, a good relative degree of comfort and confidence. And Russia was my first country, and I lived there in the early 90s. I worked for the U.S. government and designed and built the first clearing system. The system was used for SWIFT, the physical infrastructure. And I followed sanctions my whole life because I traded bonds that were subject to sanctions. So North Korea, which was okay to trade and then not okay to trade, Iraq, all sorts of countries, Libya, and so I'd seen the sanctions machine, and the sanctions machine never stops. When we saw Russia, it showed up as cheap on our process, but we thought the probability of sanctions was much higher than what the market was pricing. You're only getting 200 over for Russian dollar-denominated government bonds. And so we thought the odds were much higher, and we thought the technical was much worse. In other words, you could lose 100%. It wasn't going to be volatility that wasn't going to touch your bonds. We thought they could touch your bonds, and you'd have zero. And that's generally often when folks, we make bad calls. Often the good ones are rarely, we're totally sure this is going to happen. But yeah, with Russia, we thought the odds were higher, and we thought the impact was higher, and the payoff wasn't attractive. And a lot of folks, if they're nervous, they hug the index. And if you're nervous, think, right, and get out of things that you're not supposed to be in. But that was our attitude, and we hope that's always our attitude.
Generally, for investors, do you look at the opportunity in emerging market bonds as more an income play or a potential total return kind of alpha play in the current environment?
Yeah, I think emerging markets has opportunities in yield. Any bond investor will tell you that carry is a pretty good predictor of future returns. But EM has two additional factors that can generate total return. One is currencies. In general, we're not super attracted to currencies in the 10 years we've been managing our funds. But occasionally they can generate significant outsized returns. We think now is one of those moments. And so that's an opportunity for total return that doesn't exist in other bond categories. And additionally, because of the sometimes poor sponsorship of parts of EM, you get some spread widenings that we try to always take advantage of. And the spread compression can create total return opportunity as well. So EM has these additional opportunities that traditional bond flavors that investors have access to don't offer.
And before we kind of wrap up today, I did want to talk a little bit more about your background. You alluded to some of it earlier in a question about Russia, but it'd be great if you tell us a little bit about your background. I think you have such an interesting kind of upbringing, and I'd love to learn about how you got into this career and ended up at VanEck.
Yeah, no. So I was born and raised outside the U.S. I was born in France. I grew up in Switzerland and Thailand. Both my parents were career diplomats. My dad was a spy during World War II and then became a diplomat. He worked. He was MacArthur's economist for 8 years during the occupation. So had neat stories about that. And my mom was Harry Truman's secretary for 5 years. And so kind of that was the milieu I grew up in, I guess. After Thailand, I moved to the U.S. Moved to McLean, Virginia. Went to college, graduate school, got into Wall Street. And then I got a call from a friend of mine in graduate school who was working with the U.S. government to design and build the first clearing system in Russia. And that sounded like a great thing. That no one wanted to go to Russia then. But I did. Designed and built it. Learned about a lot about Russia. Met my wife. Then I was at Morgan Stanley for 14 years. So I loved countries and looking at economic development, but I also wanted to make a living. And so I worked at Morgan Stanley for 14 years, 10 years in research. So I started EMEA, Economics and Bond Strategy. The generous way of describing me is I was the world's leading Russian economist. The accurate way of describing me is I was the world's only Russian economist, or there was a handful of us. But yeah, I started covering Russia, then Bulgaria, Poland, then South Africa, Turkey. And what was interesting is when I covered Turkey, I learned more about Russia. When I covered South Africa, I learned more about Turkey. So you really learn, the more countries you learn about, the more you learn about, every country adds to your knowledge of the other countries. And then I moved to VanEck right after the financial crisis. So VanEck was committed to emerging markets and emerging markets bonds, and they wanted us to start a variety of strategies, and we have, and been doing that. But what I like most about my job is that I'm able to do, economic and and some political analysis, and make a living at it.
Eric, what's one long-term trend you see playing out over the next year or several years?
Eurasia is, I think, the biggest trend on Earth right now. The redirection of energy to Asia from Russia is going to be a big growth encouragement. And it's also going to be growth that the rest of the world, big parts of the developed world, are not going to be able to participate in. So that adds up to supply risks for commodities. So that's one big trend.
And, as we finish off, we have Trend or Feds, our speed round segment. I'm going to ask you about a couple different concepts and get your quick take, trend or fad. And feel free to explain if you'd like to, but you don't have to. First one is the creator economy, trend or fad?
Trend. The biggest thing that's happening is atomization. Individuals, smaller groups have huge power right now, and they don't necessarily need to be in a geographic location.
ESG, trend or fad?
In the U.S., fad-ish. Europe, not.
And artificial intelligence, trend or fad?
We're not there yet. I don't think it's there yet, but it's very neat, and I could see how it could maybe make less important a lot of things. Focus us in different areas.
Yeah, we typed it in this morning because I wanted to ask you what 3 emerging market countries offer the best investment potential for bond investors and why. And it wrote a pretty nice little piece. It mentioned China, India, and Brazil.
Yeah, India is uninvestable in bonds. Brazil, I think you gotta be careful. But okay, interesting. Yeah, no, look, it's like I said, people have made careers saying things like that. So I'm not dismissing.
Good. So you still have a job for a while until this AI gets up to speed.
I'm not worried about losing my job from that.
Well, this is awesome, Eric. Thank you very much for being patient with us today and participating on the podcast.
It's been my pleasure, Ed.
And thank you for tuning in to another episode of Trends with Benefits.